Greetings, fellow traders. I'm Dilin, a research strategist at Pepperstone, and I'm here to dive into the latest weekly update for XAUUSD. Now let's talk about the hot topic that's been buzzing in the gold market lately, the significant reversal. Market sentiment is on everyone's mind as risk aversion takes center stage due to mounting uncertainties. In this video, I'll provide precious metals performance, analyze gold against US dollar's technical aspect, delve into the factors shaping this recent development, and also discuss key risk factors to watch for the rest of the week. So when we examine precious metals against the US dollar, it's clear that we are witnessing a noteworthy recovery across the board. Silver takes a lead, showing an impressive 3.9% gain over the past 5 days. It's also demonstrating the potential to climb further and reach the previous support level at 22.23. Gold follows closely with a respectable 2.1% growth. Now let's shift our focus to the technical aspect. After hovering around 1820 to 1810 for a couple of days last week, gold against US dollar eventually touched 1810 as the channel's lower bound since mid of July last Friday. Just as we anticipated on the same day, a surge of buyers entered the market, lifting the price out of oversold zone marked by an RSI of 19. The bullish reversal gained momentum on Monday, with the market opening approximately $40 higher. Currently, the pair is trading around 1860, testing the 38.2% Fibonacci retracement level of the recent sell-off in late September. If the bulls maintain control, the price could climb higher to 1884, marking the lower boundary of the previous sideways pattern observed from the mid-May to 2 weeks ago. Beyond that, the upper limit of the downtrend from May could act as the next potential resistance. Now, what fueled this reversal and subsequent rally? Two main factors come into play. In the short term, it's the prevailing geopolitical uncertainties that are grabbing traders' attention. The recent Hamas attack raised concerns about oil supply from Iran and the broader Middle East region. These worries are not only reflected in the 2.5% weekly opening price hike in spot crude, but also in the price of gold. Gold, known as a safe haven asset, tends to shine during such turbulent times. Furthermore, should crude prices remain high due to supply disruptions, either from U.S. sanctions or the spontaneous export cuts, it could result in higher headline inflation and stronger recession expectations, further supporting gold prices. On a related note, the impending U.S. congressional vote for new speaker adds to the uncertainty, as the government shutdown crisis might not be resolved in November, giving gold an added boost. In the long term, market expectations play an important role. The consensus in the market leans towards the idea that the Fed has concluded its rate hike cycle. The rally in 10-year nominal and real yields, coupled with the 7% surge in the trade-weighted USD, supported the notion that the market has already priced in another rate hike. As a result, gold is responding to these expectations ahead of time with upward moves. In summary, the gold market has essentially absorbed the belief that the rate hiking cycle is over. If concerns related to the Middle East conflict and also the US government shutdown persist, we could see gold prices pushing higher towards 1884. Beyond the higher for longer stance, the lack of US dollar support, provided the information flow remains unchanged, may restrain the US dollar's upward performance and in turn elevate gold prices. As we move through the week, keep an eye on the US CPI data set to release on Thursday. Higher than expected core inflation figures could exert downward pressure on gold prices. Conversely, a cooler print may attract a broader base of buyers, providing gold with a potential boost. Stay tuned with Pepperstone for more insights and updates, and until then, happy trading!